Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Kirk McDonald, Argent Mid-Cap Portfolio Manager at Argent Capital, to discuss why mid-caps are positioned well from a risk-reward standpoint and a strategy that's a blend of quant and fundamental analysis. Kirk, it's great to see you again. Welcome back to Trade Talks.
Thanks for having me, Jill.
Let's talk about mid-caps more holistically. How have they performed relative to other asset classes over the past 20 years?
Over the past 20 years, U.S. mid-caps are the best domestic equity asset class that there is, and it's typically unknown by investors. They think of small caps and large caps. They forget about mid-caps, but they are the best domestic equity asset class.
What about their valuations?
Right now, they are historically cheap. So they typically trade more expensive than their large cap counterparts, for example, because they tend to be faster growing. But now they are actually cheaper. The Russell Mid-Cap Index is about a 16.5 price earnings ratio, whereas it's over 18 for forward earnings for the Russell 1000. And typically they haven't been this cheap since the tech bubble. So it looks like a very good time from that standpoint to get into mid caps.
And you had pointed out that mid caps are also positioned well from a risk reward standpoint. How is that so relative to large cap and small cap companies?
They are positioned very well. And typically when you think about it, compared to small cap companies, mid caps now, they have a management team that's been able to grow the company from small cap to large to mid cap because they have a product or services that people need. They figured out the business processes to run the company, and now they have more access to capital than their small cap counterparts, but they still have much more room to grow than large cap stocks. So from a risk reward standpoint, it ends up being the sweet spot of the market.
Let's learn more about Argent's mid-cap strategy. The ETF is ticker AMID, and it's a blend of quant and fundamental analysis. Tell us what the methodology is like behind the ETF.
So what we're looking for, the types of companies we're looking to invest in at the Argent mid-cap strategy are enduring businesses. So those are companies that are growing cash flows. They have a management team that is that's reinvesting properly in the business, so they allocate those cash flows wisely. They have some sort of a durable competitive advantage. And we identify these companies in a twofold process. We have the Argent Alpha model, which is a quantitative model that's looking for the fundamental characteristics of these enduring businesses. And that helps us find them and screen for them. And then we have a deep fundamental research bench where we're looking to think of it as like a check on that quantitative model to make sure this truly is an enduring business. Because unlike other quantitative managers, we have a very low turnover portfolio. We like to buy and hold these businesses for as long as possible.
Give us an example of a company that fits your process.
So an example of a stock in the portfolio right now that's an enduring business is Fair Isaac Company, better known as the creators of the FICO score. So when you think about it from that enduring business perspective, from a durable competitive advantage, they invented credit scores, consumer credit scores. They have over 90% market share for consumer credit scores. And in fact, any mortgage that's eligible to be bought by Fannie Mae or Freddie Mac, which is the vast majority, has to have a FICO credit score on it. So that's definitely a durable competitive advantage. And when we think about a company that's growing cash flows, they've compounded their free cash flow 24% a year over the last 5 years. And the management team's definitely allocated that capital wisely. They've reinvested in new and better credit scores. So they have over 23 types of credit scores at Fair Isaac Company. They've created a whole software platform that allows other companies to essentially utilize their decades of data on the consumer to manage their entire consumer credit life cycle, as well as for better decision making. And lastly, they bought back stock with the extra money, and they bought back over 60% of the company since 2005, and they bought back close to 4% last year. So from our perspective, Fair Isaac Company is a durable and enduring business.
All right, Kirk, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you.